When I went to go buy my first house with my parents, I did what every good American does, and I went to get a mortgage because I didn't have $275,000 in cash to purchase that home. I think most of us fall into that category, and that's perfectly fine. What I didn't fully understand, though, was how mortgages worked. At the closing table, there was a thick packet of paper which had a amortization table which shows how the principal and interest gets paid over the life of the loan. I completely ignored that. The reason this is important might save you tens of thousands, if not hundreds of thousands of dollars, and this same principle can be applied to most consumer loans like a car loan. It's not just mortgages. A simple example to give you a head start, and you won't even have to finish this video, is if you make one extra payment towards principal every year, you can cut down the life of your 30-year mortgage by 5 to 7 years, or even 20%. So, mortgages are used to allow individuals and businesses to pay for real estate without using all of their money up front. It typically just requires a down payment. As a borrower, you will pay back the loan interest for a specified number of years, normally 15 to 30 years. Most traditional loans are fully amortizing, meaning your regular payment stays relatively the same, but what changes is the percent of your payment that goes towards principal and interest with each payment. To calculate the interest amount, you take the principal amount which is left on your mortgage and you multiply that by your interest rate divided by 12. So the more you pay down the principal, the less interest you will pay with every payment after that. Alright, let's go ahead and take a look at a chart here. You can see that you're borrowing $100,000 and your monthly principal and interest is $699.21 every month. It is a 30-year loan spanning from 2010 to 2040. And if you take a look, the green is principal, the yellow is interest. So when we take a look at this chart here, you see it's mostly yellow because mortgages are front-loaded interest, meaning you're going to pay a lot more of interest at the beginning of the loan and less by the end of the loan. And that's how banks make their money. So from 2010 to about 2030, 31, you're paying the majority of your payment towards the interest. You see here they kind of break even, and that's where you start paying more principal than interest. So in that first year, for example, the total principal that you paid over the remaining 9 months of the year was $684.87. You paid a total interest of $5,608.06, meaning out of roughly $6,200 of money, you paid, I would say that breaks down about 10%. So the total balance out of the $100,000 that was paid off is only the principal, and that's why you have $99,315.13. So this example is very good to show that if you're further through the payments of your loan, you may not want to refinance, because even though you might have a lower monthly payment, what you're actually going to end up doing is restarting this whole interest being front-loaded, which makes you spend more money on interest than principal again. So if you were further along in the life of your loan, where, if it's 20 years, that's where it might not make sense for you to actually refinance a loan. Or if you've been making extra payments, it could be closer to 10 years or 12 years. It all depends on your situation and how much you are paying towards the loan itself. But most people aren't going to tell you that, and that's why I think it's very important to understand what you're actually getting into and how the loan product works. Alright, so let's take a look at one more example where we are going to look at paying a $300,000 loan with no extra payments versus making one extra payment every year. So the loan amount obviously is $300,000, and it'll be a 30-year loan with a 6% interest rate. This gives you a monthly payment of $1,798.65, and if you make no extra payments over the 30 years, your total interest amount will be $347,514.57. Now we can go and make that extra payment. So we'll go here, extra yearly payment one time of $17,098.65, and we'll calculate that. So your monthly payment obviously does not change, but what you see here is that the loan will now be paid off in 24 years and 5 months, meaning you've knocked 6 years off the life of your loan roughly. The total interest that you save is $76,438. That's a lot of money that you obviously are not going to be paying to the bank. So you can see the power of making one extra payment, where you can basically lower the amount of interest that you pay by 22% with just one payment every year. So if you want to find other ways to pay off a mortgage faster, like this example of making one extra payment towards principal every year, leave a comment down below. I've got some other ways. And also, if you found any value out of this video, please leave a comment, like, subscribe, all of that good stuff. Thanks.